Over the past few decades, we've seen the wealth gap expand, and it's all because of people that are masters of preserving their wealth and accumulation of money. Billionaires. Thanks to public SEC disclosures, we can see how they gain fortune, and recently, top-tier fund managers and billionaires have recently been insuring their net worth against a U.S. stock market collapse. Welcome to Empire Investing, where we'll be sharing the latest in stock market news, technology, and innovative investment strategies for aspiring millionaires and, yes, billionaires. If this is your first time watching our channel, welcome, and please consider subscribing to see more videos just like this. And with that, let's get started. It's a misconception that hedge funds or investment pools for high net worth investors is a risky investment strategy because it underperforms the S&P 500. However, looking at it from a different angle, most hedge funds never intended to beat the S&P because their only goal is to have consistent capital growth. Remember, outperforming doesn't always imply gains. If we compare the growth of the S&P 500 and hedge funds from 1997 to 2017, there's a lot of volatility with the S&P 500 compared to hedge funds. Before the dot-com bubble popped, you can see that the S&P outperformed hedge funds by the time the bubble bursted. The S&P went down while hedge funds didn't move as much. This pattern can also be seen in the 2008 recession. The S&P crashed by over 50%, while hedge funds only crashed for less than half of it. This is all because hedge fund managers are focused on Jensen's measure, or commonly known as alpha. The Jensen's measure, or alpha, is a metric used to measure the risk-adjusted return of a security or a portfolio of securities in line with the expected market return from capital asset pricing model, CAPM. There's always a risk involved when you invest. It's great to make a lot of money during a bull run, but if your profits disappear in a couple of months, it doesn't really matter, and that's what the Jensen's measure is for. With the recent predictions of known investors that the market will crash, a lot of billionaires right now are hedging their portfolios. This includes Elon Musk, Cathie Wood, Dalio, Michael Burry, Bill Ackman, Charlie Munger, Warren Buffett, and Chamath Palihapitiya. It is a pretty known fact that the crash is inevitable given that there's all-time high valuations, dramatic increase of inflation, and the Fed's plan to raise interest rates and purchase bonds to slow down quantitative easing. With all of these factors involved, it's obvious that the market will soon crash. Although billionaires left and right are hedging their funds, it doesn't mean that you can't do that as well. The market, despite everyone's predictions, is unpredictable, and putting your eggs in one basket is a huge mistake. What's important in hedging the market is position sizing. Instead of shorting the market, a small portion of your portfolio should be allocated as a hedge against your long portfolio. That way, in case the market crash occurs, you have the hedge fund to sell and purchase stock for long-term gains. Take Bill Ackman, a hedge fund manager that manages over $13 billion, for example. Ackman has started a small short position in the bond market. It may be a small portion of his whole portfolio, but if bonds drop, it might climb to 10% or even 20% of his complete portfolio's value. The current yield on government bonds is only 1.8%, well below the inflation rate. This rate might rise to 4% or perhaps 5% if inflation gets out of hand. Furthermore, because investors may earn 0% returns on their funds, bond rates will never go below 0%. An asymmetric risk is one in which those who short the bond market assume little risk but stand to gain greatly. Earlier last month, Ackman detailed why he thinks the Federal Reserve is understating its retraction plan. He said on Twitter, "While it has become conventional wisdom that the Federal Reserve will raise rates to 3 to 4 times this year to mitigate inflation, the market expects 25 basis point increments. The unresolved elephant in the room is a loss of the Fed's perceived credibility as an inflation fighter and whether 3 to 4 would therefore be enough. The Federal Reserve could work to restore its credibility with an initial 50 basis point surprise move to shock and awe the market, which would demonstrate its resolve on inflation." That's from Bill Ackman. Ackman is famously known for market manipulation. As you can see from his statement, he's basically putting pressure on the Feds to raise their interest rates for the economy's sake. Although his strategy is commendable, it's not a strategy you should follow. He's using bond derivatives similar to options contracts, but for bonds. Another famous strategy that you should take note of is using a long-short equity approach or spread. It basically means that you should go long and short on companies in the same sector. With this strategy, you can still earn money on the difference of the companies you invested in. This strategy is used by the best hedge fund managers for the main reason that it lowers risks for short term. The two well-known fund managers that are currently using this strategy are Chamath Palihapitiya, the CEO of Social Capital, and Cathie Wood, the CEO of ARK Invest. Chamath is shorting on Apple, Meta, Amazon, and Netflix and going long on Microsoft and Google. By doing so, no matter what happens, he'd still not lose his position. If big tech goes down as a whole, he won't be affected as much. If it goes up, he comes along with it. His strategy aims to profit on whether his long Microsoft and Google will outperform his short Apple, Meta, Amazon, and Netflix. I think the best trade on the internet, the most obvious, simple money-making trade is long Microsoft, Google short. Big tech, short the rest of the big tech. You can very comfortably short Apple, Facebook, Amazon, Netflix, and be long Microsoft, Google. So as a spread trade, it's the best risk parity trade on the internet right now. That's from Chamath. Let's watch his explanation about the quote-unquote spread trade.
When you're betting on internet stocks, you don't necessarily have to be naked long or naked short, which comes with a lot more risk than if you were long one security and short another against it. So for example, over the last 10 years, you would have made a lot of money by being long Amazon and short a basket of traditional commerce companies, offline commerce. I'm going to make up a basket, but Macy's, JCPenney, Kmart, Sears, right? So if you were short those and long Amazon, that's what's called a spread trade. You're basically playing the gap between your longs and your shorts.
It's independent of where the market generally trades. It's one of the key
irrelevant
points.
Of the market.
Right.
You're basically
because
saying
those stocks could go up, but just not
everything
anywhere
could go,
near
right.
Amazon.
Yeah.
When you put that trade on, for example, it's I'm going to bet that if everything goes up, Amazon will go up more than Kmart, Walmart, Sears. And if the stock market goes down, Amazon won't go down that much, but these ones will go down a lot. And you're playing the spread.
In the podcast interview, he also talked about another spread trade in the financial payment sector, proposing that you can go short on Visa and MasterCard while going long on cryptocurrencies.
That this is the year you can put on what probably will be the most profitable spread trade of my lifetime, which is to be short these companies. And that anybody that basically lives off of this 2 or 3% tax and be long, well thought out Web3 crypto projects that are rebuilding payments infrastructure in a completely decentralized way. Now, that doesn't necessarily mean that what you say won't also happen, both that Stripe will have an incredible IPO and that a lot of these scammy crypto projects will go to zero. However, if you read the white papers of these crypto projects, and you systematically put together a framework, I think you can be long those and you can be short Visa, MasterCard, because I think this is their peak market cap.
Chamath believes this is going to be the most favorable and profitable spread trade ever is because with the rise of cryptocurrencies and their decentralized finance system offering quick payments and low fees, it may beat Visa and MasterCard, which charges unnecessary fees, averaging to about 1.5 to 3.3% every time you spend. For cryptocurrencies to replace traditional credit card companies, they are targeting countries like Nigeria to test their payment infrastructure. By targeting developing countries that have a demand for an online payment system, in the long run, they may just be able to replace all traditional card payments.
Amazon, earlier this year, Nick, maybe you can post this, decided to just shut Visa off in the UK.
Oh, yeah.
Now, Amazon is not going to do something like that, in my opinion, unless it's a test of what they can do all around the world. And again, going back to this idea of arming the rebels, there really is no need today for all of these small businesses to sit on top of Visa, MasterCard, and Amex rails. It's unnecessary. And so it'll probably get developed in the developing world first.
This is why I think, focusing in markets like Nigeria, to me, are way more exciting than talking about, those fading Western European countries. Who cares?
Right.
This is where this stuff will happen. It's not to say that those other companies can't, trundle along for a while. But when I say, we'll look back in 10 years and their market caps will be materially lower, anybody in those traditional infrastructure and rails versus anybody in this new infrastructure and rails it will look like a no-brainer.
It may seem that this spread trade is intended for the next couple of years, but as he said, this is not where I think this disruption happens. Slowly. I think it happens swiftly, like in a year. There's Cathie Wood, who also started using the same strategy as Chamath's. Similar to Chamath, she's going long on innovative companies while going short on traditional companies falling behind because of innovation. The best example of this would be Cathie going long on Tesla while shorting on GM and Ford. Although GM and Ford are doing their best to catch up, almost all of their revenue will disappear over time. In theory, this will benefit Tesla from Ford and GM's market share.
Well, we have internally for employees only. We're testing out a portfolio, but it's really ARC on steroids, if you can believe that. We don't think we want to test it out on ourselves first and make sure that everybody keeps their eye on that 5-year investment time horizon, which is our time horizon, and doesn't pay attention to the day-to-day, because what we would be doing is shorting stocks that are in the big benchmarks. And when we get into a risk-off situation, what happens is portfolio managers and analysts generally run back to those stocks, get closer to their benchmarks, and they dump our stocks, which are either small parts of benchmarks or not in benchmarks.
Another strategy that's interesting for you to follow doesn't need to go short on companies or asset classes. This strategy is going long on international stocks. It may be a bit controversial to go long on international stocks, but a lot of fund managers are embracing this strategy and purchasing Chinese stocks. This is all because when the US dollar deflates in value, other currencies will increase in value. By holding Chinese stocks, you will essentially have a hedge against the US dollar's decline. This is all because when the US dollar deflates in value, other companies will increase in value. By holding Chinese stocks, you will essentially have a hedge against the US dollar's decline. This is because the revenue of Chinese companies will be in Chinese yuan rather than US dollars. When the dollar goes down, the yuan's value goes up. The world's largest hedge fund manager is maximizing this opportunity, Ray Dalio. Recently, as he has launched his biggest China fund that is solely focused on investing in Chinese stocks, Ray Dalio, the world's largest hedge fund manager, is taking advantage of that opportunity. Dalio recently launched his biggest ever China fund in November of 2021 that exclusively invests in China. Dalio's known for being the king of the Jensen's metric because he finds ways to lower volatility while keeping long-term returns. With his decision to add China in his portfolio, he and his clients now have a hedge against the US dollar and the US market. Charlie Munger is also doing the same thing. Over the past few months, he's been purchasing Alibaba stocks, and in the most recent news, he has now doubled down on Alibaba, which brings more than 25% of his entire portfolio now in Alibaba. And the final strategy to hedge against the upcoming recession is to just hold cash. Elon Musk believes that recession will come as early as spring of 2022, and even before he made that announcement, he's already sold a portion of his Tesla stock. There's also Warren Buffett, who's adding the same thing. Berkshire now has a cash sum of $149 billion, totaling at a market cap of approximately $715 billion. This means that more than 20% of the market cap is in cash. If you decide to follow this last strategy, you have to keep position sizing in mind. The market may continue to go up, and the cash you're holding will probably get eaten by inflation. By learning these tactics that billionaires are using to hedge against the market crash, you can find your own perfect strategy that can help you win long-term gains despite the incoming recession. Although you won't have as much money as these three billionaires, the mindset of having necessary positions to protect one's portfolio should be followed to counter losses. That's all for today. Let me know how you're going to hedge your portfolio against the incoming recession. Join the discussion in the comments below, and if you've liked the video, please do click the like and subscribe button. We'll see you guys in the next video.